In my experience, these incredible obliterations of growth stocks, they do end. In fact, they tend to end at the end of the third day today, and the best ones start bottoming as early as tomorrow. After all, these growth stocks have been pulverized since Powell's pivot in November, that it wouldn't be too surprising if the selling lets up sometime soon. So in other words, you can see that the market's going to open down again tomorrow. Hey, by the way, if the market opens up tomorrow, please don't get fooled. It will start going back down again. That's just scalpers who bought it right here, and they'll flip it right here. In my opinion, that's what's happened. So how should you position yourself? Not this trading stuff, but how should you position yourself now that the Fed's serious about fighting inflation? All right, first, the companies with no earnings or big losses per share, in other words, the ones that are losing money per share, they can try to bottom. They even can try to bounce. But they have no real place in your portfolio right now because they're just not as good as their profitable peers with good balance sheets, many of which have come down big, especially in tech, and also have good growth rates. Now, I know there was negative chatter, say, about Salesforce today. Salesforce seeing its business slowing, but that stock's down more than $80 from its highs, including 20 points just today. It sells at 48 times earnings. Granted, that's not cheap versus the average stock, but it is not an average company. It's rarely cheap, and it looks a lot like past bottoms in this terrific tech company. Can it go down another 10, 15, 20 points? Of course. I started liking it at 8, all right? I mean, every time it got crushed like this, if I just said, ooh, I'm scared, think about it. How many times I would have been faked out? How about Meta Platforms, the artist formerly known as Facebook? That stock's down 60 from its highs. Now it sells for just 20 times earnings. What is it, a cereal company? 20 times earnings for one of the fastest growing companies in the world. That's a pretty darn attractive point. Palo Alto Networks, really expensive, down more than 65 from its highs, but it's doing spectacularly, although it sells at 70 times earnings. If that one drops another 35 points, I would pounce. So by 35 points, that's like a blink of the eye. Finally, you're getting a chance to get back into Nvidia, which is very expensive, as always. But it's down 70 points from its high, sells at just 50 times earnings, had a great talk from the CFO today at a JP Morgan conference, and yesterday by a terrific gaming guy at CES. You know what? I'd say if the stock opens down, I'd start buying it tomorrow. There. Now, understand, I'm highlighting how far they've fallen from their highs because I always hear people complaining that they bought at the high. They bought these high-quality tech stocks when they were flying. You're certainly not buying them at the high today if you bought them. Certainly not tomorrow if we go down again. You're buying them after they've been down for days and days and days, if not weeks and weeks and weeks. And even though they might be clobbered again tomorrow, well, you got to pick your spot here. You can't act as if this was their first day down.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.